The only public evidence that America spent its own money holding up Japan's economy is a photograph of a handwritten to-do list. Sitting in front of the Secretary of the Treasury, one line legible from across the room: buy yen, 5 to 10 billion. That photo was taken at 11:33 a.m. on July 31st. That Friday, for the first time since 1998, the United States walked into the currency market and bought yen. The receipt was a doodle on a notepad. Here's what makes this strange. The rate America pays to borrow for 30 years just hit its highest level since 2007, and the country we just helped prop up holds more American government debt than anyone on earth. So why are we doing this? Trump's answer on Air Force One: we have a good relationship with Japan. They wanted a little help. Japan's been very good to us, with the exception, of course, of Pearl Harbor. Friendship and Pearl Harbor in the same sentence. Tokyo's answer was stiffer. The intervention countered excessive volatility in the yen. Translated, the yen was falling, Japan was hurting, and America stepped in. So where does a government get money to buy foreign currency on a Friday afternoon? A pot called the Exchange Stabilization Fund. The Secretary of the Treasury can spend it without asking Congress. He just needs the president's signature and the credit card opens up. It was created with one goal: to stabilize the exchange value of the dollar. But throughout history, that's not what it tends to get used for. One Treasury Secretary reportedly used it to buy an $8,000 Oriental carpet. Another took a 42-person trip through London, Moscow, and Mexico City for $131,000 with no identifiable purpose. The statute says the Secretary's decisions on this fund may not be reviewed by another officer or employee of the government. But here's the detail that actually matters. America didn't buy yen with dollars, it sold euros. Roughly $13 billion of the fund is held in euro assets. America sold Europe's currency to buy Japan's, and the European Central Bank only found out after the trades had cleared. Senior European officials called it unprecedented, a break from decades of convention, and the timing makes it stranger. On July 23rd, the Treasury published its currency manipulation watch list: China, Germany, Korea, and most importantly, Japan. 8 days later, that same building bought Japan's currency. So America broke a 28-year rule, paid by dumping Europe's currency, only told them after the trade was done, all for a country it had listed as a currency risk the week before. Why? Because Japan owes more relative to its economy than any major country on earth. This year, debt servicing costs jumped nearly 11% to 13 trillion yen. At the same time, the yen hit 40-year lows. The reason is simple math. Japan's benchmark rate sits near 1%. America's sits near 3.5 to 3.75%. Capital goes wherever it's paid more, so investors dump yen for dollars. Why doesn't Japan just raise rates to close the gap? Because it's trapped by its own design. To keep borrowing near zero for decades, the Bank of Japan bought trillions of its own government bonds. It now owns about half of its entire domestic bond market. Those bonds pay almost nothing on purpose. But if the BOJ raises rates, it has to pay trillions in interest on deposits while still earning almost nothing on the bonds it's stuck holding. It can defend the yen, or it can afford its own debt, not both. Japan's only real lever: sell dollars. It's the largest foreign holder of U.S. government debt on the planet. In May, Japan sold $66.7 billion in Treasury holdings, the single largest one-month drop by any country ever. It worked for about 3 weeks. Then bond math kicked in. Flood the market with unwanted treasuries, prices drop, U.S. borrowing costs rise. Higher U.S. rates widen the very gap driving the yen down in the first place. Economists call this the FX intervention doom loop, a machine that eats its own tail. Which brings us to the real fix, a Fed tool called the FIMA repo facility, essentially a pawn shop for central banks. Japan hands over treasuries, gets dollars, buys the bonds back later slightly higher. It lets Japan raise cash without ever becoming a seller on the open market. 48 hours after the July 31st intervention, Treasury Secretary Scott Bessent publicly asked the Fed to consider expanding this facility. Strange because the facility's $60 billion ceiling per country was sitting completely unused, zero balance, 8 straight weeks. He wasn't asking for more room because he'd run out. He was asking before anything had happened. Former 40-year Treasury veteran Mark Sobel offered the quiet part. Beyond friendship, the real concern may have been that a collapsing yen was pushing America's own long-term borrowing costs higher. So, the president says friendship, the Treasury says stability. The man who spent 40 decades inside Treasury says there's more to it. None of this was hidden, a data release, a tweet, a photograph. You just had to dig for it. Because the story that gets reported and the story actually unfolding are rarely the same one.